The next term, to make sure we understand all the same, is capital. So the term capital is used quite broadly across the board when referring to different things in the investing world. And capital can be representative of cash, properties, assets, or anything with value or benefit, whether it's personally yours or part of a business or a company you're researching in. It's usually associated with cash that is productively used for investment purposes. So when looking up information about companies, you'll hear businesses and analysts commonly refer to it when talking about future growth. Thirdly, we should understand what market cap is. And it's really just shortened for market capitalization. And if you consider that we just learned that capital is really the term for invested money that has value or benefit to the owner, then market cap is the term that is used for a snapshot of the total capital at the present value that the market gives an investment or company. Not necessarily what the company or investment is valued at or worth, but what it would be or could be worth if you took current traded share price and multiplied it by the number of shares available. Let's say for illustration purposes, there's a company called K2 and it has 100 shares available and is trading for $50 per share. That would put the market cap of K2 at a whopping $5,000, 50 bucks times 100 shares. So it's also used as a measure to illustrate present value on the open market of what the whole stock market amount of dollars invested is worth. So as comparison of size and wealth to the fictitiously valued company K2, we get the following. As of January 2024, the US market cap is $46.2 trillion, which would be if you could imagine buying every single share of all the companies that is publicly traded in the US stock market at the currently traded price, which even Elon Musk would struggle to be able to do that. That's what it would be, $46.2 trillion. Now thinking of the terms of an investor and long-term trades, or holding an asset longer than 3 years in duration, it tends to be a blend of more than one of the 7 different investor styles. And let's go through them here. So the first one is an active investor style. And this really indicates that the manager of the money is expected to beat the average returns of the market. And this is ultimately where you will be once completing K2. Next is a passive investor style, and that indicates that the investor accepts lower fees and that the direction of the market is almost as identical to the performance of your return. And gotta be like an index. The next one is a growth investor style, and this indicates an investment strategy focused on capital appreciation by investing in companies that exhibit signs of above average growth, even if the share price appears expensive in terms of metrics. Next, we'll do the value investor style, which indicates that an investment strategy involves picking stocks that appear to be trading for less than their actual value based on fundamental analysis. Now think back to the slide on the definition of market cap. As a reminder, market capitalization is the total value of a company's shares in the market. So share price times the number of outstanding shares. And the next 3 are really three different categories of market cap companies. And long-term investors tend to weigh more to one side or the other. But here's the range of the 3 different market cap companies. Small cap investor. And that style indicates an investment strategy that invests in stocks or companies with a small market capitalization between 300 million and 2 billion in size. These companies are generally more affordable, but also more volatile as they're smaller companies. And the next one is a mid-cap investor style, which indicates an investment strategy that invests in stocks with a mid-size market capitalization between 2 billion and 10 billion. And finally, the last one, which is a large cap investor style, which indicates an investment strategy that invests in stocks with a large market capitalization greater than 10 billion. Companies that perform well generally reward the investor or shareholder with dividends or increased share price. It should be noted that the K2 style you will learn is to be more of an active investor than a passive investor, but you can blend your capital to be some portion to be passive if your risk profile supports it. K2 is going to teach you how to determine companies that are undervalued and companies that offer strong growth. And you can decide on your level of comfortability how much of your portfolio should be growth or value. You may know of a famous investor, Warren Buffett, and his style is primarily a value investor style.